Hey traders, Raghee here, and in this premium video we're going to dive into something that we've been emphasizing a lot over the past few weeks, and that is just shortening the time frame and definitely within the context of a market that, look, is this necessarily choppy? It has been choppy, but certainly, moving with a little bit more bullish bias as of the last couple of days. But up until, say, Monday or even Friday of last week, we were still pretty much stuck inside of a range that was pretty easy to identify within the Darvis and within the volume profile of the point of control value area high, value area low of the month of April. We've broken out of that as of today. We've hit the 200 period exponential moving average to the upside that you can see with the dots, but we're still sticking with pretty short-term time frames. And I want to do a deep dive into that because I want to kind of talk about what I did and didn't do, things to look at, why, and the process. So this is really going to be another day trading deep dive. We have a lot of new members in the room, so we're going to go through the process here in this video. And then in the meanwhile, I'll have supplemental videos like I did this afternoon where I sent out what I call the grocery store commodities, and the shorts that are on my list there are corn, ZC, soybeans, ZS, soybean meal, ZM, and LE, which is live cattle. So I'll do additional videos like that to kind of keep you in the loop of what is on my radar. Because if I'm going to be shorting grains or meats, it's going to be in one of those four, if not maybe all four of those symbols. So here, day trading, let's put our day trading caps on. Now this isn't specific to now. This isn't specific to this particular environment where it seems like the worse we hear the economy is going to be, the better the stock market gets. And I can talk about the disconnect between Wall Street and Main Street till I'm blue in the face. There's no really denying that. However, let's think about this from the perspective of not caring about any of that longer term, macro, whatever you want to call it. Let's leave that on the shelf and say, look, we just want to day trade every morning. So the first thing I want to talk about in the morning, and I'm going to do this tomorrow with you all, let's go through the same process, is where did we close? Right? So I'm going to go back to yesterday and take a look at that, because if you follow what we're going to talk about in this video, you will be able to replicate what we did, what I do by and large. And even I'm going to troubleshoot a little bit of the things that I could have done differently today. And I think in that troubleshooting, you're going to learn a lot too, right? So those two circles there, notice I don't get highly hyper specific about the actual 4 p.m. close and the 9:30 open. I want to get a gist of where the market is opening, and it was approximately 50 points on the S&P. So first of all, the question is there a gap today? Here we go. Is there a gap today? And then how big is the gap? Is it at least as big as the daily price movement range? So then I head on over to Auto Chartist. I take a look at the S&P and ask, all right, what is the typical daily price movement range on average? It's about 60 to 65 points. Today we were on the 50 area. So is this an average size? No, it's actually just below average, which tells me that for the S&P, while there is going to be a gap psychology in play, it's not ideal. The higher that number, the gap points, is within that daily price movement range, the higher degree of probability the gap guidelines are going to have to put us in the right direction. Okay, so that's number one. Now we can do this also in the Russell. I'm just going to show you something that did have a proper size gap, and that is in this area. I'm just circling the area around the close, and then I'm just going to circle the area around the open. And what we had here was something that was a little bit more along the lines of what we would want to see in terms of a larger gap, in terms of a gap that would have more of a larger impact on psychology. So here's the Russell. We have about 30 points. So you can see in terms of the Russell, I think it was almost 40. You can see here, yeah, we were in a usable gap environment. Now clearly, if it's closer to the high than it is the average, that's even better. That's even better. But at least the average, preferably closer to the high, that means that gap psychology is going to be higher. And what do I mean by gap psychology? What I mean by that is once the market opens, and let's talk about that. Let's talk about what we had to consider on the open. So once the market opens and we're looking at the first 3 to 5 minutes after the bell rings, what we're looking to see is what kind of mood is the market in? Are there any momentum indications for early moves? And really what we had, very interestingly, was early bearish momentum, which would be in line with sort of gap psychology, early bearish momentum, and favoring the short side. Now, favoring the short side brings us to a couple different things. Number one, there's something we call a caution day, right? Today was a caution day because of the FOMC. Now, if on these particular days you choose to not trade smaller size, trade only using options, and or trade only from conservative levels, all of that would be fine. So on a caution day, what are your choices? Don't trade. There's nothing wrong with that. Flat is a position. Trade smaller size. Control risk with one of the easiest ways to control risk. Trade smaller size. Trade using options. That's going to also give you a whole lot more flexibility and risk control. And trade or enter. There we go. Enter from only conservative levels. Those are all ways that you can control risk on a caution day, right? And I'm sure there are other nuances that are related to those four, but those are four really easy ways to deal with caution days. All right, and don't underestimate the first one. Okay, so if you've chosen not to go with the first, then clearly the next three, right? So it's really don't trade or the rest of these, right? That's really what that is. It's don't trade or consider one, if not all, of the following three suggestions, okay? All right. So next is we've dealt with the gap. We know the size. We know it's a caution day. We've thought about the four choices are really binary, yes or no. And if it's a yes, we go with those other three options, those other three suggestions. And then we ask ourselves, is it risk on or risk off? So for that, we consult in not any particular order. I like to start with the currencies. I'll take a look at the yen. So on the open, and that would be the 6J. So let's type that in, 6J, yen futures. So what am I looking at on the open in yen futures? What kind of mood are the futures in on the open? Yen was actually, as you can see here, moving higher. That's yen strength. So going into about 10 o'clock, it made sense to think about playing equities, at least for a short amount of time, so says the yen, to the downside. Strong yen typically means weak equities. But that's not the only thing we want to consult. What about the Australian dollar? Now, COMDOLs, Australian dollar, New Zealand dollar, Canadian dollar, are also going to have a say about risk appetite and risk aversion. And you can see it's a little bit of a topsy-turvy move. Initially, you can see we kind of moved up, then we moved down, but kind of a choppy, mixed picture from the Australian dollar. You can also take a look at the Canadian dollar as well. Again, up or down. Canadian dollar was actually, as you can see here, anticipating what we were going to ultimately get from the crude oil market. I'll talk about that as well. But again, kind of not a really clear picture from the COMDOL side of our currency. All right, what about the bond market? What about bonds? If bonds are, let's get this typed in. All right, there we go. If bonds are strong, typically that's going to mean slight influence to weak equities, right? Bonds were strong, so I have kind of strong yen. We had some dollar weakness that also propelled the yen higher. I have strong bonds. I have kind of a wishy-washy COMDOL picture, so finally we can go to the VIX, maybe in this case sort of the tiebreaker, right? We have the VIX. We take a look at the VIX, and the VIX was weak. Weak VIX typically means strong stocks. So right off the bat, what do we know? Mixed picture. It's not like we have yen strength, Australian dollar weakness, VIX strength, and bond strength. That would be clear risk aversion. So let me show you what the risk off and risk on looks like. So risk on, that's what that would look like. Risk off, that's what that would look like. Okay, so I'm giving you textbook examples of what we want to see strong and weak. to understand whether or not indices would be strong or whether or not indices would be weak. All right. So that's our next kind of going down the list. Is it risk on or risk off? Today was mixed. But, one thing we know is with Powell and with the GDP, we had a couple interesting things on the economic calendar. Scheduled was the GDP, scheduled was Powell. The GDP was awful, gang. There's no two ways about it. And in any sort of normal world, and I don't mean that sarcastically, I just mean that factually, in a normal environment, which this is most definitely not, but in a normal environment, to print a negative 4.8% GDP when the anticipation was for a negative 4.0, that would typically make the market kind of nervous, kind of concerned, right? Well, how did the market react? And I'm going to pull up, say, the Dow for this. How did the market react with the 830 GDP? All right, I'm going to scroll back to 830, and here is your 830. Nope, that wasn't it. Let's go right to here. Here's your 830 GDP reaction. Really? We get an awful GDP reaction and the market heads up. Well, something else interesting happened today too. And that interesting thing was this. Moments around the GDP release was the news about GILD, Gilead, and the drug that kind of vaguely holds some promise. All right. It wasn't black and white. This is working. We have the tests are done, clinical. No, none of that. But there was some vague optimism about it. Nonetheless, rather interestingly, I'll use that word, we get probably one of the worst GDPs some traders have ever seen in their life, a negative 4.8% GDP. And that was, let's call it strategically, also accompanying this news about GILD and the drug. So what was the response? People ignored the GDP and they focused on the optimism around the drug? Very likely. But that's the world that we're in. Ignore what is concretely bad news and focus on what was vaguely positive news. And that's where we sit. So market heads up higher. And maybe that was the first hint at what was to come. We get our gap. We get some of the initial gap momentum. We look at potential resistance levels to play, anticipating perhaps kind of a back and forth into Jerome Powell. Instead, the market just continues higher. And that's really what we saw. Okay, even after, we can see a sell-off going into the 2 p.m. FOMC, a rally after the 2:30. And why did the market rally? Was it because Powell had such good things to say about the market? No, in fact, he had awful things to say about the market, the economy, and Q2. But the awful things equate in this environment, gang. This is actually pretty, it's working pretty consistently. The worse the news is, the stronger the stock market gets, because the expectation for continued strength in the equities markets, because the Federal Reserve is going to have to remain accommodative, keep rates lower for longer, continue to print money, continue to backstop this market, dare I even say subsidize the stock market, which is really what we're seeing. That expectation goes higher. The worse the news, the more help we anticipate by way of stimulus and Fed monetary policy. And so if that's the world that we're in, this is something we were learning over the past 6 weeks, if that's the new reality, that's a really big shift from things that have been, most traders have spent their career, if not, learning and reacting to. But this is where we are. This is how we adapt. If this is sort of the if-then, if there's bad news, then we'll look at more strength in the equities markets. Then that's that, right? Now, we would like to also be able to interpret this technically, right? Like I said, it was a mixed bag today. It was a mixed bag for sure. The gap psychology was not the overriding psychology. So then the other thing we ask ourselves is, did we have proximity to hourly price movement ranges on the open? So take a look, and we'll cover this tomorrow as well. I make this tool available free to members. So we have the HPMR here before the open, right there. And a lot of folks are asking, Rod, can we use these HPMRs before the bell rings? Absolutely. But remember, at 9:30, we're going to see a higher amount of volatility. And so you have to be ready for those higher price movement ranges, that reaction between 9:30 and 10 that occurs when the bell rings. So keep that in the back of your mind. Can you use HPMRs if you're looking for buys and sells? Well, proximity matters. Do we have proximity to support? Do we have proximity to the HPMR support? Or do we have proximity to HPMR resistance? Which end of the range we are at is going to matter. Speaking of which end of the range, now we can move on to V-score extremes. Are we at one end or the other of a V-score extreme? We really weren't, because in many ways, many of the early morning V-score extremes were far lower than where we were. So had I printed a -2 V-score in the morning, that would have been an easy place for us to say, look, there's a low risk buy that we can take. But the only thing that we did get, which is kind of aggressive, was the HPMR, as you can see here, right before the open. So those are things that we have to remember, that if we want to have an entry really close to an extreme low, extreme high, so we're able to take advantage of low risk entries, shorts at the top of the range, buys at the bottom of the range, that V-score is going to be really helpful. We were nowhere near a V-score reading pre-market that we could use during the clearing. But there's a second psychology. We have the 2 to 9:30 a.m. reading on the V-score, but we also have the 9:30, right, to 10 o'clock reading on the V-score. And if we get that 9:30 to 10 o'clock reading, again, what do we have here? 9:30, 0. 10 o'clock, 0. In other words, that's actually about 50 minutes after 10. But notice that on the open, this is about 6-7 minutes after the open, 8 minutes after the open, our clearing range high-low was a +2 V-score reading and the mean. So we have the 2 to 9:30 V-score extremes, highs, lows, and then we have another window of opportunity to look at the V-score readings during the clearing, 9:30 to 10, which showed us that we could look at a +2 as resistance and the mean, or even just in front of the mean, as support. All right, lots of ways to break down the ranges. Now I'm showing you the V-score extremes or the V-score high-low ranges. All right, so we could look at the 2 to 9:30 and then also the 9:30 to 10. You put all that together and you look for your directional bias. So if I were to go back in time and look at my decisions, I'm not saying it would have been an easy peasy buy. I could have been more bullish, but I really didn't get the moves to the downside that I wanted. The one thing that we did get is a move to the resistance zone. We were just looking for the market to go, say, from a resistance area down back to support, where I would have been happy to shift gears and get long. We just never got that. The market stayed bullish even through the FOMC. I would tell you probably 80+% of the time, the press conference, the FOMC presser, creates a move lower. Not today. Why? The new reality, gang. The worse the economy seems to be in terms of data and what even comes out of the Fed's mouth, the more the market seems to rally in anticipation of, you guessed it, more stimulus, more money, more accommodative monetary policy. That's the new reality. And so tomorrow we're going to talk a lot more about this in the open. I'm going to go through the same process. We'll go through it in the live market. Watch this video, then come into the room tomorrow at 9:20. We're going to go through the same process again. We had a really good day on Tuesday. Today, the market just never gave us some sort of the back and forth that we were expecting, especially with the mixed bag on our barometer, our yen, Australian dollar, our COMDOLs, bonds, VIX, crude, right? I think crude was a big reason for some of the movement. I do think we would have seen a quick pullback and we could have taken advantage of that. But when crude got the slightly better than the expected buildup, it wasn't a drawdown, but when the crude built up 1 million barrels less than the 9.9, it was 8.9, crude shot up. But, I think as we ended the day, you really see that the market thought better of what they did. I mean, look at this. This is where crude was going into the inventories, and then just go forward. Look at where we ended. So yeah, was this just whatever? Did the market really want to get up to about 1680? No, you can see here we pretty much stayed at that level of reaction for the EIA report. Pretty interesting. I think minus this, we would have had sort of the back and forth crawling up action that I was looking for to take advantage of this morning. But we didn't. So we just kind of chalk it up to a great Tuesday, not a great, wasn't awful, but just not moving in our direction on Wednesday. We get to do it all over again tomorrow. That's the great thing about the day trading. Just start with a clean slate every morning. Okay? Hope this was helpful. I know it's a little bit longer video, but this really is a very thorough 20-minute breakdown of exactly what I do every morning and what we're dealing with right now. Hope this was helpful, and I'll see you in the next update.